When you look at a company, it's so easy to get wowed by what it owns, right? The flashy headquarters, all the cool tech, the piles of cash in the bank. But that's only half the story. Today, we're going to flip the balance sheet over and look at the other side of the story, a company's liabilities.
So let's get right into it. Think of this as a little financial detective story. Our mission? To answer that one big question. What does a company truly owe? We're going to hunt for clues hidden on the other side of that balance sheet, the promises, the debts, and all the obligations that really tell you what's going on.
All right, so what actually is a liability in the eyes of an accountant? Well, they've got this really strict three-part test. First, it has to be a current obligation because of something that's already happened. Second, it has to be probable that you're going to have to pay up. And third, you have to be able to reliably estimate how much it's going to cost. Now, if something doesn't tick all three of those boxes, well, that's when things get interesting. And that's where our detective work really begins.
Okay, here's our game plan, our case file, if you will. We'll start with the basics, then we'll dig into those tricky, uncertain costs. After that, we'll grab a key detective tool, understanding the value of time. Then we'll tackle how companies borrow huge sums with bonds and solve the puzzle of leasing. And finally, we'll put all the clues together to see what this all tells us about a company's future.
So, our first major clue, it's all about how companies deal with the phantom menace of future costs. The ones they are pretty sure are coming, but they can't quite nail down exactly when or for how much.
This is such a classic accounting puzzle. Let's say a company's in the middle of a massive lawsuit. They think it's pretty probable they're going to lose and have to pay out a huge settlement. The thing that caused the lawsuit, that already happened in the past, but they just don't know the final bill. So what do?
Well, this is where the path splits. If that loss is probable and you can reliably estimate it, the company has to create something called a provision. Now, a provision is the real deal. It's an official liability that goes right there on the balance sheet for everyone to see. But what if the loss is only possible, or if you just can't estimate the cost? Then it's called a contingent liability. And this is a huge clue that gets tucked away in the footnotes, the fine print, not on the main page.
And here's what that looks like in the real world. AstraZeneca faced a potential fine in China for $4.5 million, so they created a provision. Now look at the impact on their books. Right away, liabilities go up by $4.5 million, and at the exact same time, because the provision is an expense, it hits their profit, which means their equity goes down by that same $4.5 million. Now the key here is that no cash has actually left the building yet, but on paper, the company's financial health has officially taken a hit.
All right, now before we can investigate some of the really big long-term liabilities, we need to add a super important tool to our detective kit. This little tool helps us figure out what promises that are due years from now are actually worth today. It's all about the value of time.
Let me ask you a super simple question. If I offered you £1,000 right now in your hand, or that same £1,000 but 3 years from now, which one are you taking? Yeah, I thought so. You'd take the money today, of course, but why is that such an obvious choice?
The answer is one of the most fundamental ideas in all of finance, the time value of money. It's simple. A pound today is worth more than a pound tomorrow. Why? Because you can take today's pound and invest it, and it can start earning a return. That potential to grow is what makes today's money so much more valuable.
So how do we figure out what that future 1,000 quid is worth in today's money? We use a cool process called discounting to find what's called its present value, or PV. And it's really just a simple three-step process. First, you know the future amount, £1,000. Second, you pick a discount rate. That's basically the interest you could be earning somewhere else. Let's say 10%. And third, you just plug it into the formula, which basically just unwinds compound interest over time.
And when you run the numbers, that promise of £1,000 in 3 years, it's only worth about 751 quid today. That gap, that almost £250, that's the cost of waiting. And this is so important, because to really understand a company's long-term debts, we first have to translate all those far-off promises into the value of today's money. Okay, so now that we're armed with our new time value of money tool, we can investigate our next big clue: how huge corporations borrow billions of dollars. We're talking about bonds, which are basically just giant billion-dollar IOUs.
So what exactly is a bond? Well, think of it like a formal loan contract. A company, the issuer, borrows money from a whole bunch of investors, the bondholders. And in exchange, the company promises two things: to make regular interest payments, called the coupon, and then to pay back the original amount, the principal, on a specific date in the future. It's like getting a loan, but from thousands of different people instead of just one bank.
Now, the price of a bond when it's first sold is a really interesting dance with the market. In the simplest scenario, if the interest rate the bond is offering, that's the coupon rate, is exactly what investors could get elsewhere, the bond sells for its face value. We call this selling at par. Easy enough. But what if interest rates out in the market are higher than what the bond is offering? Well, think about it. Why would you pay full price for something that pays you less interest than you could get somewhere else? You wouldn't. So to make it attractive, the company has to sell the bond for less than its face value. It sells at a discount.
And you can probably guess the flip side. If the bond's coupon rate is higher than the going market rate, suddenly it's a hot item. Everyone wants it. So investors are willing to pay more than the face value just to lock in those juicy interest payments. The bond sells at a premium. So how does one of these discount bonds actually look on the company's books? Let's break it down. The company only got, say, £95 in cash, but they have to pay back the full £100. Now, they pay a fixed £9 in cash every year. But the real interest expense is actually higher because it's based on the growing liability. That extra bit of non-cash expense gets tacked onto the bond's value each year. So the liability on the balance sheet actually grows and grows, until, right at the very end, it hits exactly £100, just in time to be paid back. All right, time for our final clue, and this one is a biggie. It deals with one of the greatest sources of those hidden obligations. We're looking into situations where a company has complete control over a billion-dollar asset that it doesn't actually own. Welcome to the world of leasing.
Just think about this for a second. An airline might be flying a massive fleet of jets. It's their entire business. But what if they don't actually own a single one of them? What if they're all on long-term leases? If those huge promises to pay aren't on the balance sheet, are we really seeing the truth about what that company owes?
To fix this, accountants have this great principle: substance over form. Basically, if a company signs a long-term lease and gets pretty much all the economic benefits of an asset, we call it a finance lease. It doesn't matter whose name is on the legal title. For accounting, the reality of the situation is what matters. And the reality is, it's like they bought the asset with a loan.
And the impact of this rule is huge. That lease gets slammed right onto the balance sheet. On one side, an asset called a right-of-use asset pops up. And on the other side, a lease obligation liability appears to match it. This forces companies to come clean about their real commitments, showing the world the massive debts they have for things like airplanes, stores, and all sorts of equipment.
So, we follow the clues. What's the final verdict? We've uncovered provisions for costs that might happen, the real debt behind bonds, and the massive obligations hidden in leases. Each one of these isn't just a number. It's a promise. It's a commitment that a company has made, and it's a commitment that is absolutely going to shape its future. Because in the end, assets show you what a company has right now, but liabilities reveal what a company has promised for the future. They tell the true story of its risks and its obligations. So, I'll leave you with this question. Next time you open up a financial report, are you going to be dazzled by all the stuff the company owns, or are you going to start by investigating what it owes?